Hey traders, a very warm welcome to you. Welcome back to the video. So today I'm going to talk about the 3-line break chart. Well, the line break chart, but I'm going to set it for 3-line break because that's the most popular and that's the one that I believe is the best for us to use. Okay, so how does it all work? So first of all, let me explain what I've got in front of me. I have a Dow cash chart that's adjusted for cash, so perfect for spread betting, CFDs, that kind of thing, the sort of thing that you get from your broker. And I have here exactly the same thing. They're both daily charts, so each candle is representing one day. One is a standard candlestick chart, one is a 3-line break chart. Now, again, thanks very much to the Japanese who invented this for us. They gave us candlesticks, they've given us all sorts of good things, of ways of displaying a price for us and getting us involved in trends. The key difference here between regular candlesticks and 3-line break is that time is of no relevance. All it's interested in is price. Price is the only thing you will see on your break chart. So how does it work? Well, a candle is formed when the prior high is broken. When we get a close above the prior high, you will get a candle. So in this instance here, if I zoom in wrong way around, let me get the drawing pen out. This candle here, we'd only get a close on the next candle if we'll only get a candle drawn, should I say, when we get a close above the prior candle. So if we look at the time period for this as well, let me scrub that off a second. Look at the time period here. We're talking what is 7th of December, 8th of December the next one, 9th, 12th. So we didn't really get an actual bar here until several days later. Now that could have been the weekend, so let's see. Here we've got a 7-day difference when we got a bar. Here we go all the way now till the 1st of January until we get a break below. Let's have a look at that on the actual chart itself. Where were we when we saw that? So it was the 1st of January. Let's scroll back. We started here, so we didn't get the print until round about here, and that makes sense, doesn't it? Because we were here and it was the 19th. So if we look at that, the 19th of January, we scroll here. As we broke below that low and we got the close on the 19th, we finally get that first red bar or candle after a massive uptrend, and that shows you here on the 3-line break. We've got green, 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 green. Every single time we close above the prior high, prior high. Sometimes every day, sometimes it takes a while, and that's the important thing. When we start chopping around like this period here, let's have a look at this, shall we? Examine this. So 14th of December onwards, let's have a look at it on the 3-line break chart. So here we go, look, 13th of December, we didn't get anything until the 20th, and then we finally got that break to the downside. And that's really all of this from here all the way up to here. So all that isn't displayed. So what's the point of that? Why have we got that? Was it any useful for us? Well, the idea is it keeps us in the trend. If we're long, we don't come out until we see the first red bar, because it eliminates all the noise and it just keeps us on the right side of things. It's basically saying, listen, if supply demand is imbalanced and we have a good move to the upside or the downside, well, let's use upside for example here, we stay with the trend. If it makes a little bit of a pullback, that's fine. You're not going to get the red candle because it hasn't broken and closed below the prior 3. If we do and it eventually prints, then we get out of the position or we take the short. Now, the disadvantage, of course, is that if we look at this one, this is a great example. And by the way, this is a daily chart. We can use it on a 1 minute if we wanted to, 3 minute, 5 or 15. All depends on how quickly you want to trade and the kind of day trading or swing trading that we're doing. The disadvantage, of course, is, let's look at this as an example. The close here is, the high I've got is 21,097. That's on the 1st of March. And let's just bring it up and so we can see what's going on here. 1st of March, that's this high spike here. All right, pretty obvious that will be where we were. There we go, got it. So that's the high spike there, and then we finally get a red bar indicating a 3-line break reversal 20 days later on the 21st. So that's going to be probably around on this low print here. Okay, so all that move there. What happens, unfortunately, with a 3-line break is it's very slow to react. You know, if you are coming out of your position, or let's say you are waiting to initiate a short and you initiate a short here, or let's say you're long and you're stopping out on the first pullback here, you've sat through what's that, 21,200 give or take, all the way down to 20,300. So almost 1,000 points or so, not quite 1,000 points, 900 points pullback in the market. Now that's the advantage. The advantage, of course, is that it's keeping you in the trend. You're not coming out on little 50 tick pullbacks, 70 tick pullbacks, whatever you may do if you're swing trading. But of course, the disadvantage is that it's quite laggy, and by the time it triggers, you've already pulled back quite a lot. So that's up to you to kind of gauge how useful it is. Let's have a quick look at a shorter time frame chart and see what's going on there. So if we stick on a 15-minute, not a bad kind of time frame if you're day trading, just to see, kind of get the sentiment of the day, but without being, you know, caught in longer term stuff. Let's have a look at this point here, because this was quite interesting in the Dow. And again, it could be any part of a time frame literally just picked. I'm not cherry picking, we're just going to analyze it and see exactly what's happened. So we get the push down, as we see on the 3-line break. We get the reversal finally, but that's coming in at about 7:15 UK time, and if you look at that, that's triggering quite late. However, you know, let's give it some credit here. Even though it's triggering late, it's actually kept you in all the way through. If you'd taken this on the first red at about, which is the opening print, so pretty much you're getting short at the open and you're taking it all the way to the downside. Yes, you're giving back a big chunk, but it's keeping you in the trend. Now obviously we can go on a shorter time frame, dial it down to a 5 minutes. We're going to get more frequent signal. Oops, let me take the drawing pen off, guys. Clear that screen. Obviously we're going to get more signals, but, and actually in this case on a 5 minute, because it was such a trending day, it kept us in. Now the chances are you could get whipsawed out of it. That is the downside that you've got if you kind of dial down the time frame. You could get whipsawed out, but it's going to get you out of the trend a little bit earlier, potentially, depending on obviously the price action that comes with it. So 3-line break, worth looking at. Go and check it out on Google, or give me your comments below if you use it. If you've got another way of using it, perhaps you use it on different settings, perhaps you have a different way of trading it. Would love to hear your thoughts on it. If you like this video, give it a thumbs up, don't forget to subscribe, and I'll see you on the next one, guys. Take care.